This map of the US illustrates more than just a growing concern. Each circle represents employees that have been laid off by
Amazon will be eliminating
30,000
white-collar jobs, or 4% across the business. This is the largest corporate layoff in Amazon's history.
Something very strange is currently occurring after years of historically staying in sync to each other. These two lines have quickly diverged past predictions, and this is something that hasn't formally happened before. Why is that? Well, it's because these two lines represent Amazon's profits to its reported employees. However, it's not just Amazon that's experiencing this. If you zoom out even more, you can see that this is a common trend that's occurring throughout Fortune 500 companies in comparison to the employment rate. So what's actually causing this, and what does it mean? Well, many believe that the recent technology advancements are driving this change. However, the main driver is related but oftenly overlooked. It's known as investor optimism. You see, in our current state of economic cycles, we're witnessing similarities with the pre-dot-com bubble, and it's the opinion that every CEO is admitting to. While there are many indicators, the main one that we're seeing is equity prices climb substantially more than the company's growth. In particular, if we look at Amazon's PE ratio, which is just a ratio between price and equity, analysts typically expect PE ratios to be on the range from 10x to 20x. However, it's currently 34.95x, and it's not just Amazon. Apple, Microsoft, and many more are averaging around 28.3x. This means that for every $28.3 that you pay for a stock, you get $1 in earnings back. And with the Mag 7 contributing 54% of the S&P 500 earnings, it could be assumed that optimism is carrying the current stock market past unprecedented levels that we only see during previous bubbles. And this form of optimism causes layoffs, which enables companies to allocate capital to
data centers, chips, and the infrastructure needed to compete in those hyperscaler wars.
And we're seeing this in real time as the stock price increased due to the layoff news. Fundamentally, we could expect other major players to play similar moves. However, current companies' trajectories may quickly diminish. You see, as investment optimism decreases, we would likely see a collapse in the AI bubble. While this wouldn't enable a gradual increase in previous roles, it would change the trajectory of employment, as many of these companies would have to recalculate, similar to post-COVID when
Amazon added all these workers and then realized they had too many workers and they cut 27,000.
Ultimately, we may see an inverse in the current trajectories. However, only time will be able to tell. Intel has also reduced its workforce by 24,000 employees. However, it's uncertain if this will reduce the risk that investors anticipate in the company. In our previous video, we explored Intel's equity risk by utilizing Python. You could click the link to view it.